Good afternoon, ladies and gentlemen, and welcome to the FIREANGEL Safety Technology Group PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all questions submitted today will be reviewed, with responses published on the Investor Meet Company platform where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to Executive Chairman John Connolly. Good afternoon, sir.
Good afternoon, many thanks. Welcome everybody to this short seminar. My colleague Zoe Fox, our CFO, and I are actually in the same borrowed office in our broker's Shore Capital, even though we seem to have mysteriously different backdrops. So we'll now take you through the presentation of our interim results. Very briefly, although many of you will know some of our history, it's always worth bringing this forward at the start of our presentations. We are very well positioned in our marketplace, which is primarily the UK and in particular Northwestern Europe, Benelux and so forth, but also Germany and France in particular. We have sold a lot of alarms. The big thing that drives our sale of alarms and keeps providing a following headwind is, of course, that we operate in an environment which is driven by legislation. And in most years, there is always further positive pressure that supports the company's position. So we do operate in a strong place where we already have strong support through our historic activities. The highlights of the first half, I think, summarised in 4 words: great performance, really, terrible macro. And the terrible macro has, of course, continued and morphed and changed as the second half has gone on. But it was a strong performance, with the gross margin actually ahead of board expectations. And we were delighted that both revenue and gross profit were the highest in 5 years. Key point, the demand has continued to be higher than our ability to supply. We were very constrained in 1Q, but there was a good rebound. That demand absolutely continues to now, and it's hard to see it having a major reduction despite what we know of the macro environment. As I say, we offer life-saving technology for the home, and legislation tends to drive that for us. The key highlight outside of the core activities of the business was the selection of our CO sensor by Techem for the development project we're working on with them, and I'll deep dive that slightly in a moment.
Just to reiterate what John's just said, it was a strong start to the year. The interim results we're pleased with. Revenues are up 15% to 25.6 million, and also profit is up 8%. Gross margin is at 21.9% for the half year. That is under 2021, but I think it's important to draw out the 1.6 million of exceptionally high purchase variance costs. So these were costs the business incurred to secure components to continue to keep continuous supply from our manufacturers. Normally, these costs don't really appear in our profit and loss. Last year, we started to see some come through at the second half of the year, and that was 200,000. And we don't expect these types of costs to continue. We may have some in H2, but not at the level of H1. And if you exclude those costs out the numbers for half year, then you do get an adjusted gross margin of 28.2%. This is the highest gross margin since 2017 for the business, versus a like-for-like comparison in 2021 of 24.3%. So you can see why we are pleased with those first 6 months of the year, that those gross margins are showing that we have actually started to deliver on what we said on the gross margin improvement plan into our numbers, and that gross profit is coming up for the business. From EBITDA, we're at EBITDA of 100,000 year to date June, versus last year of an EBITDA of 200,000. Again, if we take out that 1.6 million purchase price variance, then we are at an EBITDA level 1.5, and that is, again, you know, the best since 2017. From an inventory point of view, we're still less than what we probably would have liked. Demand certainly outweighed our supply for the period, and we ended the year, the half year, on 4.7 million inventory. The net debt, again, also materially better than what we were forecasting internally. We finished the period on 3.8 million, of which that is about £700,000 cash, and a drawing on our IDF facility of 1.4 million. Net debt as of close of business on Friday the 23rd was a little bit above the 3.8 at 3.9.
So just to give a bit more colour, best year in certain respects for 5 years, but particularly pleasing was after the real concern in 4Q last year and 1Q was to get that rebound in terms of supply. We could still have sold more, and do note that Q1 is normally our second best quarter of the year after 4Q. So it just goes to show you our kind of missed opportunity, but it wasn't for lack of the efforts of our company or our suppliers. Component shortages were a fact on the ground across an awful lot of industries. A good example of how legislation drives us forward is Benelux. Again, there we could have sold another 3 odd million, we think, possibly more, frankly, but it's great to have had Benelux have its best sales in the region for the entire 20 odd year history of the company. So yeah, a lot to be pleased about. Normally we leave the outlook till the end, but because of the materiality of it and the complexity, we thought we'd bring it forward to not be disingenuous in the presentation. We are EBITDA positive today. We do still expect to be cash generative in H2, and obviously expect to expand that cash generation in 2023. And those would be major milestones. The revenue is expected to be towards the top end of market expectations, but the key thing to highlight is, whereas PPV was the big impactor of 1H and still will chip away a little in 2H, the big change is currency. And even at the mid-year, we were making decisions on scenarios ranging from about 117 to 126. Obviously, recent changes have, knocked that. So we are materially downgrading the profitability. Slightly wide range, but that is because there are a lot of moving parts. We will deep dive currency and our reaction to it shortly. But the shame for us is if you'd asked Zoe and I in June, although obviously we wouldn't have answered, but when Zoe and I were discussing in June, we felt we had a really strong chance for upgrading revenue and profitability come September. Even in August, we thought we could probably upgrade the revenue, even if we didn't feel quite as confident about upgrading the profitability. But here, yeah, we're still pleased with the revenue outlook, but we've had to call out that the impact of currency is just too big a headwind at the moment. So we expect a good rest of the year, but if the rest of the year goes as we think, then we've shown our first proof that the turnaround is working, and that's a prize. So just to group some of the highlights along the themes from our fundraise of early last year. We have been planning much further ahead in many ways, but it's all about the margin for us. And we had a big initiative to bring in a new range of products for the low to mid range of our market. And that came through about on time. We've already shipped 500,000 of those. And that has added about 3% of margin to the company. So it's a good success. We said we were going to do it back in probably end of 2020, and we delivered. So we're pleased about that. The big one on this page is, of course, Techem. This is the transformational agreement that we announced previously. Just to remind you of some dimensions, originally we were going to earn about €3 in royalty and fees per product manufactured. With the selection of our sensor to go in this product, it will now be about €5 per product. The forecast from Techem for units will be about 7 million, so you can do simple maths there. It's clearly a colossal opportunity. However, we also know reasons why that forecast could go up and reasons why it may go down. But so far, the project is going very successfully. In addition, of course, there are other revenue streams, such as we are being paid to develop this technology. And as we go, we are able to then reuse the technology in our own core products as resource becomes free. So that would have been paid for. And secondly, as we reach certain milestones, we receive other payments through the contractual arrangements, which are very valuable. And again, we passed one of those in June, and those total about €1.4 million. The development phase we're in is advancing well. It's on time, on track. I mean, as we speak, it's probably another % or two further on. The key thing we're doing now is selecting a manufacturing partner. We've issued a letter of intent. Let's hope that this is the partner we end up selecting. We're probably a little bit behind there, but if we've got the right partner, then that's the key thing. So that'll be the next thing we'll update on with regards to Techem, we expect. As those of you who know us will remember, the more we can sell connected technology, which is much higher margin than traditional standalone alarms, then the better the whole company's margin will look. It was disappointing that supply of those products was, of course, particularly impacted in the first half. Very disappointing. But there's been a rebound. We expect to ship 500,000 this half. We could ship more. We continue, however, to develop other additions to our connected range, about which we'll say more next year as we reach certain points. But we expect that our further developments to add quite a lot of richness to this story, and we expect connected to keep becoming a larger proportion of what we do. And because it is the way the world is going. Zoe.
So over the last 12, 18 months, maybe a little bit longer, we've been looking at different improving efficiencies across the business and improving our predictability within our supply chain. An example of sort of our efficiencies of the EDI, we've taken on another 7 of our major customers this year onto EDI, which has resulted from having about 10% of our orders processed this time last year via EDI to over 50% now. That's obviously released some resources that's enabled us to deal with the growing demand and the volume of the business, but also given us additional resources to be able to work better through our supply chain and better customer experiences. And just so on the supply chain, we are now looking out a lot further. We are committing to the end of 2023 at the moment with our partners and beyond for specific components. That's also been helped with the establishment of a standby letter of credit of up to £3.5 million, which we announced in June, and that's supporting the extended working capital of our suppliers through the supply chain challenges and the extended lead times that's on some of our components now. Alongside that, we've also worked to remove all the plastic out of our packaging, which obviously has not only environmental benefits, but also cost benefits to the company. And that's added a 1% gross margin to the business. We think there's more to go at for the packaging and cost savings, and this isn't something that we've just done and left alone now, and we are continuing to look at the business and what else from a gross margin improvement we can do, whether that's packaging or other sides.
So one of a couple of touches on the currency in general kind of input issue. You're clear by now, it had a PPV in particular had this material impact on first half, and obviously we have these other impacts coming through. We'll come back to currency again, but we weren't completely idle. In fact, we certainly weren't idle this year, just like all the other years really. We worked hard to rejig how we work with some of our channels to make pricing changes easier. By the way, it's not that easy anyway, but our first range of pricing increases came through into the market as 2Q progressed. Because we've really built up quite a backlog of unfulfilled orders due to supply reasons. We had quite an overhang of orders at the old prices, not all of which we could swap onto the new rates. But by now, that first pricing increase has had pretty well 100% of its impact. But our next slice of price rises across all our products starts to take impact during 4Q. During 1Q of next year, we'll reach its full impact. We can probably go a bit further with that, but we also do need, as Zoe said, to keep looking at our internal efficiencies. Passing all of it onto the customer doesn't feel like the right thing to do. So we've begun the budgeting process, so working out where we think we can land next year on gross margin, but it is looking like it's really about the currency, and PPV and inflation will be not quite the drivers they are now. Let's hope that's accurate.
So this chart, for any of you who were part of the March presentations that we did, was a similar chart on there that showed, and certainly from the market expectations, where we had a 28% gross margin for 2022. So we can see here how we have a 6% variance on that. So that's been driven from, we've got additional, as John's been referring to, it is that, the FX, the inflation, the purchase price variances that has given us a 16% increase in our costs for this year. Now, as we've talked about, we've got the gross margin improvement plan that's helping significantly to mitigate some of these cost prices. But we're just not quite getting to the percentage increases that we'd hoped 6 months ago because of the external factors of the higher inflation, but also the supply chain constraints that we've had. So in those higher activities, we had that transition to our entry-level products to Chinese manufacturer. Now that's been really successful. We've sold over 500,000 units, and we are seeing the gross margin additional percentage points into our bottom line for that. So it is delivered and it's doing well. We've had the introduction of our new CEOs, and then there's that Techem business and the profit the extra profit that's coming through the P&L and that P&L for that. So that's a 6% increase from last year to what we expect going forward for the full year. And then on the connected and the pricing, so we do have pricing strategies now within the business. It is a continuous activity at the moment, trying to keep up with that inflation and the FX variances and pushing what we can back to our customers. It's just not always possible to get the timing of that. There is a lag to push that into the customers quick enough. And as we said, we're looking at other ways of getting the cost down as well. And then on top of that, the connected product to us is more higher margin product, and in the H1 of this year there was restricted supply on the connected products. We are, however, seeing that increase in H2, so that's helping driving the margin up as well, but it's just been slower than we would have liked for the year.
Oh, excuse me. This chart just reflects the importance of connected products. For us, connected products can sell at 40s, 50s points of gross margin. We're going to have one point product that goes up to about 70 points of margin, which is kind of different, very different to the traditional standalone products. In yellow there is the are those connected products versus in solid grey, they're more standalone products. We are fairly solid on commitments for 4Q, but we added shaded in, so you can see 4Q last year would have been literally incredible. The shaded parts are where we, just weren't able to supply products. So, but as you can see, 4Q is a big quarter. We're very confident in it. We have great visibility. Forecasting is just a rolling process almost, and we do feel very confident.
So moving on to the financial statements in a little bit more detail. From an income statement point, we've already said it was a strong start to the year, that 15% gross margin, increase in revenue to the 25.6. The gross profit at 5.6 million for the year, with that adjustment going through for the PPV, that would have been 7.2 million. Operating expenses, we did start to see in the first half of the year that inflation starting to come through, in particularly in headcount. As a business, we have layered in a cost of living increase of about 6%, but there was other inflationary costs coming through our P&L in the first half and more coming into the second half. So we finished the period at a loss before tax of 1.7, and then the EBITDA of 100,000. Again, if we'd added back that PPV, that exceptional unusual cost, we would have been at a positive EBITDA of 1.5 million. So on the balance sheet, we saw a strengthening of the balance sheet last year from the CBILS and the fundraising, and that, the balance sheet is still in a strong position. We have tight control over our net debt and our cash, net debt finishing on 3.8, and the introduction of that standby letter of credit of 3.5, helping hopefully we're expecting that to help as we move out of this year into next year to drive up those creditor days again, because in H1 they were still at 19, so we're still having to support that additional extended working capital in our suppliers. Cash flow, there was an outflow of 2.8 million for the period, inflow of 4.3 last year. That obviously reflected the fundraising and CBILS coming through. Working capital outflow of 2 million. That is predominantly probably driven by the debtors, as at the end of June. The inventory was very small movement through the period from the end of 2021. Debtors closed high as we had a really good June sales. We were over 6 million in sales for June. Reduced capital expenditure as we've been using our resources on the Techem project, which is obviously fully funded by the customer. And then we started to repay back the CBILS as from May 2022. Drawings on the IDF started in March and were 1.4 million in the period. So overall, from an outflow and a net debt position, we're pleased with where it ended in June. Business unit revenue. There's some exceptional performances across some of the business units in H1, particularly in the international sales, where we can see is a 55% increase, driven by the legislation in Benelux, where the Benelux territory saw some of the best sales that we've ever seen in the history of the business going through. UK and trade sales were the business units which were the ones most suffered from the constraints of the supply of the products, in particular the connected products going into the trade. But as we go into H2, we're seeing that, you know, ease, and we're seeing those revenues coming back into those business units. We start to see that, you know, we had £1.7 million worth of revenue for Techem. That includes the backwards IP and the royalty, the guaranteed royalties, as well as product development fees going through there. And we saw increased sales going through the fire and rescue and utilities compared to last year. Last year was restricted we're still seeing restricted on access into properties, which has affected those two business units. So overall, you know, we're pleased with that 15% revenue increase on prior year, but we could have done more. If we'd had the inventory, that we definitely would have done more.
So to be specific again on, or for the first time actually, on currency, this is the big adverse story of the second half, and particularly the last few weeks. What we are really pleased with is that we just decided to take the downside out of it. It was painful to decide to, in the end, lock in the rest of the year at a blended rate of 115, but probably that looks like one of the best decisions of the year, because we didn't hesitate too long over it. And you know, credit to Zoe for driving that through. And that's you know, compared to where we started the year, where we budgeted at 136, and then our central scenarios at around July were around 122. It still looked good on the year, and here we are. But it really was, we don't want that downside. Clearly, this will impact gross margins next year. We are forward hedged. We have about 30% of next year at $1.15. We are actively reviewing. This isn't something we're now going to be waiting till the next board meeting. We have good experience at board level, and Zoe and the non-execs are going to cluster around this on a quite regular basis going forward. So we are looking at other things than purely hedging, ways of paying in different currencies and so forth. But we're just going to go at it. It's now just another thing to manage far more actively, perhaps, than we felt we used to have to. We watch any UK government initiatives with interest right now. Coming back to Outlook, we are looking at showing a really substantial growth. If we had full supply all year, we might have been near the kind of 50% growth over last year. It's phenomenal, really. I say again, of course, EBITDA will be materially lower, but I hope we'll feel more upbeat if we get to the end of the year. We have generated cash with a good outlook for 2023, having delivered an EBITDA positive year, and hopefully facing demand that, even if there are wobbles in the economy, is driven by legislation, and such that demand continues to remain strong. The Techem opportunity has become larger. We're delighted with that, and we're just going to continue to adapt to the changing circumstances. We are fortunate that demand is strong for what we do, and that we are in a market that really supports what we're trying to do. So we're well placed in the medium and long term, and certainly in 2024, when we get to the first cash from the Techem opportunity, and then from Techem sales, let's say, and then that moving to volume around mid-2025, that's really exciting. And of course, there will be other hopefully significant regulatory moves that should really give us a very good medium-term outlook. Final summary: we are delighted but delated. We are delighted but deflated, because we thought we would be here talking about why we're upgrading, being feted by our brokers with Babysham or whatever brokers drink these days. I'm probably out of date due to not being able to be in London so much the last couple of years. And so we are, nearly everything we have tried to do has actually worked, probably to a higher degree than is normal, because stuff goes wrong. You know, you set out to do stuff as management, sometimes some of it just doesn't work. Well, a surprising amount of what we've done this year actually has worked. It's down to the macro. So we're delighted with what we've done, deflated. So that's the formal presentation. And I'm willing now to go across. A number of questions have come through. Feel free to add more, and we'll answer those ones we feel we can. So just going back to the top, Jake D, the growth in Belgium, is it legislative driven? That was pre-submitted, so in effect we've answered that. Yes, it's a one-off, but what is notable about all the legislation, in no country is it one and done. It goes in increments and increments, and then there's a newer technology or a newer facet. And so this appears to be more or less endless, this following wind from legislation somewhere or other. You also ask how much of the decline in retail, etc., is from destocking, which other suppliers in the DIY sheds have reported. It's not destocking, there's tons of demand. I was with one of the trading directors on Friday of one of our biggest 3 customers, who supplies to DIY and trade, let's say. And he said, I apologise for the difficulties early in the year of supplying. And he said, actually, your guys have been great. We've been very happy recently with the supply, but everything you can send us, we can shift. Send us as much as you can. So I would say, no, it's not destocking. It was we could not get enough supply. Some colour on the relationship with the lenders. I might start that, and then Zoe's had the most recent conversations. We're with HSBC, and I'm not quite sure why we've still got the habit, but for the last 3 years, we talk to them more or less every 2 weeks. We have a set thing, so we give them a half-hour update on what's going on in the business. And frankly, I think they enjoy it rather than they need it. But we are consciously trying to have a trusting relationship with them, and so we don't like to surprise them. We always give them a lot of runway about risks we see, things that might be likely to change, and they've been really good to us. And so, to the specific question, Zoe, have you spoken to them since yesterday's announcement or in the lead up to it? And if so, what did they say?
Yes, absolutely. As John said, we have regular conversations, and I was speaking with Bank only probably Friday and also corresponding in the last couple of days. So what do they say about it? They were understanding. They understand the FX implications. They also have been very much involved in the work that I've been doing with trying to manage our FX risk and HSBC Treasury Department. So, it's a very open conversations with them. And, we're also talking to them about, future ways of funding working capital, etc. as well. So, it's a good relationship, an open relationship, and they are fully supportive, as what I think was also evidenced in June with the standby letter of credit.
Yeah, they've been good, HSBC. I've had worse bank relationships, put it that way. The next question, Zoe, you're on a roll.
Yes, we have. We have booked our shipping. We booked most of our slots at the end of 2021 for all of 22 and all of 23. What are the prices? They're more than what we were paying in 2021 by quite a lot. They do, however, have a sliding scale down as they move further out, and we've benchmarked them. They are competitive, if not a little bit below rates of today.
Thanks for those questions, Alistair L. Michael D saying, are you currently considering further diversifying your product range, and if so, can you give any examples? Well, I probably skimmed over this a bit too quickly actually earlier on, but it felt like bit of a deep dive at that point, but now is a good time to pick that up. The big product we need to get out the door next year is which has really slowed down over the last year because mainly because of recruitment and competition for skilled resources, against which we've prioritised Techem. But we will be bringing out a gateway finally in volume from around the middle of the year, probably 3Q. We will be piloting it extensively in 1H. And the point about this is it will be able to bring in environmental data. So just to go big picture for a moment, we are all interested in the fact that neither we or our relatives suffer CO poisoning or smoke inhalation or injury or death. And that's important, but you know, in a cold winter in the UK alone, we suffer something like 50,000 excess deaths. So people forget in this kind of global warming paradigm that nearly all deaths due to temperature are down to cold, and that is the killer. None of us die if we go to Mexico of heat. And if energy is going to be a big problem across Europe this winter, and people are unable to afford it, or there are blackouts, and so forth, and it also could be a very cold winter. I know a lot of countries suffering their earliest frosts in recorded history earlier in September. You know, that's quite a recipe for a lot of societal problems amongst older people across not only the UK but across Europe. And so our ability through our product range to be there with sensors on the ceiling becomes quite a kind of solution to that. So the gateway we bring out next year, which will offer the connectivity for our traditional smoke and heat and CO alarms, it will also have temperature and humidity, because I think we'd all like to know if our aged relatives are warm enough in their home or if there are other problems, and particularly in a social housing environment. But later this year, on a mobile phone, we're bringing out, I think it's the Android app first, then very quickly the iOS, but a thing whereby we can just tap using our mobile against our CO alarms, which also have CO and humidity sensors, and just get a snapshot of what conditions have been like in a dwelling over the previous 30 days. That could be very important in a social housing environment where there's an intervention of some sort required. And I may have given this anecdote previously, but and I bet a lot of us here know this deep down, but the FRS told us a couple of years ago, they said, you know what, often when we visit an old person in their home alone, they turn on the heating for a visit, or for when a relative or carer comes, you go out the door, they turn it down. So I think this will become a bigger thing, with possibly the energy shortage, cost of living and so on, giving more impetus to a wider definition of safety in a field in which we can play. So Michael D, that was a lengthy answer to what we see ahead of us, but I hope that made you see that we're thinking as widely as possible. When is the Techem development expected to complete? Well, the actual development during next year, we should see resources redeploying from the development phase in the first half, as the focus goes much more towards the manufacturing, but we need to be in tooling fairly soon. So the clock is really ticking on the manufacturing partner. First products late 2024, not too material, but starting to contribute, including from a cash point of view. But real volume is really middle of 2025. But for me, when we get to 2023, it's not going to look so far away. And I look forward to the day when we can show mock-ups and all of that of the the product look. So that will start to get more exciting for us next year, and much more real. and when Techem can start to show and really engage in more detail with a wider set of their customers. So good to see the progress of Techem from Sammy. Would you look for similar partnerships for US Asia? Well, yes, we would actually. The Techem product is giant, and it wouldn't really have crowded out other things, but it has a little, just because in the skill shortages that you all have heard about across this year, we have to prioritise resource towards Techem. So there's a little bit of delay elsewhere. So why I say that, because we can't really take on 2 Techems at once. But we would look at other big and small partnerships. We do have conversations, by the way, literally nothing major imminent, but we do have some interesting opportunities, maybe or maybe not material, we'll see. But the Internet of Things world in connectivity is not a single player game. It's a team game, and partnerships are going to be part of it. We are very open, and we've learned a lot, and I would expect us to have other partnerships of different types going forward completely. The London Local Authority trial of technology is completed. I'm not sure which one this is, so I'll make it a general comment. Something that absolutely took a back seat in the current year, we were developing some quite sophisticated conversations about data and risk and getting people to envision where they could be in 3 or 4 years. All of that took a back seat to, you know, if we can't supply the basic alarm, which is kind of what people are, you know, your minimum qualifying point, trying to have a sophisticated conversation with them is not what we or they want to do. So I'll be blunt, we lost a chunk of pipeline over that would have been quite interesting. Right now, we are starting to rebuild that impetus, because it took us a couple of years to build up to that point, and we kept it alive through COVID and so forth. But really, we're now rebuilding, and this will become more the story again of next year. But I think it'll be a more sophisticated story, as I say, about more than just risk, but about, or at least fire and smoke risk, but much more about the general health and safety in the home, be it residential, you know, private or social. We still think we are, you know, thought leaders in this. We really think the products we're starting to look at will open that up, and software will feature more and more in our discussions. Are there any legislative tailwinds? Jeff, see any legislative tailwinds like the Benelux legislation? We are floating up with some of Michael Gove's levelling up legislation to do with the number of alarms in rental properties. There's always a leading or a trailing tail from various bits of legislation. Probably the next big one, of which we have no detail, but we believe they're working on it, is likely to be in France, 24, 25, 26. But we have no understanding of that. But assuming that, you know, given that at some point in 25 they'll pass the 10-year anniversary of last time they brought in big legislation, we believe they're looking at something. We have literally no visibility of what that may look like, but it looks to us like that might provide opportunities, you know, overlaid with Techem. 24, 25 could be interesting years. Robbo, what are the competition doing as you move prices up for FX and inflation? Do they have the same issues, and are they taking advantage by holding prices? Are they moving with you? We don't yet know all of that, because we all move at different speeds. Certainly, we have seen some price rises. ACO in particular seem to go on an annual basis, but at the end of the day, we're all primarily buying components that are denominated in dollars. Yes, could we risk moving our prices up ahead of competition? I think we've had room to do that. I mean, I think arguably we were too cheap 2 or 3 years ago, whether or not we really realised that. But we can only price for what will make us a good and viable company. If that affected a bit of our volume, it wouldn't really trouble me. Probably make life easier. But at the moment, it's not causing an issue. As I say, overwhelmingly, we're all buying components denominated in dollars. Bhavesh, do you have any update on local authority partnerships? No, I mean, it's a bit like what I said. I don't think you'll see kind of suddenly a material progress soon. We do continue to supply alarms. We don't supply interesting, newsworthy stories at the moment. That's really getting that momentum back in 2023. I don't think it's cost us anything at the moment in terms of significant lost sales, probably a little bit, but it's the direction of travel. We want to look like the people in the connected world, and that will attract more customers and more partnership opportunities to us. Robbo, despite the progress, the share price is at an all-time low. Are you feeling vulnerable to an unsolicited bid? Do you feel major shareholders understand the issues, have faced, or remain supportive? Yeah, that's quite a good question. Obviously, questions like that are delicate, and you know, one can always take whichever the amendment it is in the US. I don't feel particularly vulnerable because our prospects are very solid and we are not distressed. And this is only about currency right now. All the shareholders we spoke to so far, and we've got quite a lot of conversations still to have, by the way, are very understanding actually, and whether or not it comes through to you guys, I mean, look, we're all different, and as I say, we haven't seen all the major shareholders yet. They absolutely get it. They're not seeing, you know, the smoke and mirrors that I suppose, you know, in myth or occasionally in actuality, the sort of wool pulling over the eyes thing. We've tried to lay out so that you can unpick our story, what the impacts have been, and you should be able to get back to the sorts of GM that we said we do, the sorts of GP revenue, and of course profitability. So they get that it's outside influences, but they also get that we have significant prospects through Techem and legislation. So from a board point of view, someone would have to start talking stupid money, and no shareholder to this point has exhibited any particular depression about where we are. You know, maybe someone will in the rest of the week. That's not the mood we're getting. And by the way, with our two brokers, they make sure they talk to a lot of people. We're getting very positive noises back. Obviously, everyone's disappointed. No, we're not finding any undue pressure. I think we have established a lot of trust, and we wouldn't betray that trust lightly. So, no, I'm not feeling vulnerable to an unsolicited bid. It would have to be crazy money. But in the public markets, whenever there is literally crazy money, then things can happen. But that's why would anyone do that? I mean, I don't see it. I guess a lot of you guys are invested in a lot of companies where you're thinking, well, you know, there's lots of American companies and we all look cheap. I think there's a big hurdle to jump with us. And I think we can deliver a lot. I really do. So our prospects are bright, and as that's the last question, I might wrap up by re-emphasising we're delighted but deflated. It was a really good year so far. It really was, and we would have liked that prize of sitting here having an upgrade discussion. But as I say, I think when we've got over it a bit, and hopefully we're in either December giving it an interim comment, or let's say January with a fuller trading update, depending on which we opt for, or both, we might feel delighted that actually we've turned the business round, which is what we expect. So we'll get over it, and I think the share price will get over it. there's more goodness still to come as far as I'm concerned. And look, I'm quite a big investor myself. I don't know how much you guys all tend to put in on a given one, but believe me, I think I've put in, I haven't counted it recently, but 200 to 250,000 pounds, you know, that sort of size. I'm quite motivated. I really am. So I want this to work. Okay, let's draw that to a halt. Look, thanks for all your questions. I like this IMC platform. We will continue doing it, and I hope it works for all of you guys. And I think it's important. I really do, and I think we like doing it. And as I say, it's great seeing your questions come through, and I'm glad there were none that we just felt we couldn't touch for whatever reason. Okay, we're going to wrap up.
John, that's great. And Zoe as well. Thank you very much indeed for both your presentation and for answering all those questions that came in from investors this afternoon. Of course, if there are any further questions that do make them available to us, we'll make these available to you immediately after the presentation has ended for you to review and then add any additional responses where it's appropriate to do so. John, I was just going to ask you for a few closing comments, but I think you well delivered those. So if it's okay, sir, I will redirect those on the call now for feedback. So could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of FireAngel Safety Technology PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.